Hey guys, welcome back to my channel. It's your girl Mimi, and in today's video I'm going to be sharing how to buy a house in Canada. Consider this a crash course. So recently I posted how I bought my house here in Canada within 10 months of landing here, and I got a lot of messages from you guys. So many of you congratulated me and I'm so grateful. And also there are so many important questions in the comment section that I felt deserved this video, and I want to share how to buy a home here in Canada. So first thing first, not everybody can buy a house in Canada. So recently the government of Canada had made changes on who is eligible to buy a home in Canada. So first, are you a permanent resident? Are you a citizen? Are you a student? Are you coming here on open work permits? You know, you want to know if you're eligible to buy. Right now, because of the housing shortage and the whole scarcity going on, permanent residents and citizens are the ones that can easily buy a home right now. Now, if you're a student, I know it's not impossible. And if you're on open work permit, it's not impossible. But I also, based on my research, I figured out that your interest rate will be higher. And that's just because of these recent changes that the government made, okay? Now, that aside, how do you qualify for a mortgage in Canada? Using my experience on how I was able to get this home after 10 months. We'll just dive straight into it, guys. The process is the same for everyone. First, you need to understand how much home are you looking to buy. So let's say your budget is to buy a house of $800,000, okay? To mortgage. When I say buy a house, you can either buy outrightly or you are doing a mortgage. In my case, it's a mortgage, so I'm going to be using mortgage as example in this video. So you want to buy a house of $800,000. The down payment for that is 5%, 10%, 15%, 20%. It's up to you how many percent down payment you want to put down for your mortgage, right? So I'm just going to use the minimum, which is 5% as an example. So the entire mortgage itself is $800,000. I need to have 5% of that $800,000, but there is a catch here. The first $500,000 of that $800,000 is where that 5% applies. The remaining $300,000 on top of that $800,000, you have to pay 10% of it. So let's assume my house is $500,000. All I need is 5% of my $500,000. But because I've passed the threshold of $500,000 to $700,000 or $800,000, that amount, the amount at the top, the remaining amount, which is the $300,000, is now 10% down payment that I have to add to my already 5% down payment. Okay, I hope that makes sense. Now, the things that are within your control is to ensure that you have saved down your down payment, right? That's number one. Number two is to build your credit score, guys. So credit score is simple. This is a credit society. So you come to Canada, you open a bank account, they give you credit card. Ensure that you are spending the money in your credit card and you are paying it back on time. The key word, on time. Don't hold credit card, because that will just make your credit score to dive, okay? And it is so difficult to get your credit score up once it goes down. It's easier for you to build it up, but once it goes down and you want to try to come back up, it might take you a year or two to get a good credit score back. So buy things with your credit card, pay back your credit card on time, and I can assure you that within 6 months to 8 or 10 months, you'll be able to get a good credit score. So right now in Canada, a good credit score is anything from 650 and above, okay? If you're on the 700 and 800, that's an excellent credit score. And there is an advantage of having a good credit score, okay? One of those advantages I figured out when we're doing our mortgage is that the interest rates the bank will give you has a lot to do with, I'm trying to put my thoughts together, has a lot to do with how good your credit score is. So if I have a bad credit score and I approach the bank, the amount the interest rate they are going to give to someone who has a good credit score and the interest rate they are going to give to me who has a terrible credit score will not be the same. To put that into perspective, my interest rate when I was doing my mortgage was 4.74%, and we know that right now interest rate is crazy all over, okay? But put this into perspective. If I have a bad credit score, or if I had a bad credit score, I will be talking about 9%, 6%, or even something just crazy, because what your credit score is trying to tell the bank or your lender is that you are not good at paying back loans. You are not good with money, okay? So, and the common mistakes that I think I should say this, common mistake, I've seen people who are not necessarily bad spenders or people who just want to squander money, but the tiny mistakes they make is you want to get something that is as simple as buying a phone, and you go and get that phone on a credit, on a finance. Now, it's not a bad thing if you're paying that on time, because that would also help you build your credit. Credit just means you are borrowing and you are paying back. So when you go and buy an iPhone to finance, these things help you build your credit score only if you are paying them on time. But some people would buy phones, cars, even do study, take credit loans, student loan, all of these things, and if you're not paying back on time, your credit just keep going, and without a good credit score, you cannot buy a house. It's important that I'm emphasizing on credit score, because this is something that is within your control and something that you yourself can use your hand to ruin, okay? So yeah, credit score is very important. And then that out of the way, guys, it's important that you get a full-time permanent job. I'm going to explain, because there are contract jobs, there are permanent jobs, there's a difference. A permanent job is telling the bank that your income is consistent, okay? Now, that being said, I'm not going to tell you that if you just land in Canada, or I don't know what your situation is, and you're just trying to make ends meet, and you find a job that can put food on your table right now, please grab it. Okay, I'm just saying that, but have it at the back of your mind. Let your goal be that while you're on that job, you're looking for a role that is going to be a permanent role, because it's easier for the bank to approve your mortgage when they see that you and your spouse have permanent jobs. You're just simply telling them that I'm not going to default on my mortgage, and I'll be able to pay I'll be able to pay my mortgage every month, okay? So getting a job or targeting the kind of job that will make you qualify for that 800,000 house that we are using as an example. Now, your household income is a big deal. It's not just enough to get the down payment of 800,000, the 5%. Getting a job that will qualify you to be approved for the amount of house you are looking for is equally important. So this is how the bank will calculate how much you will qualify for. They are going to put your household income together. So if you're a single person, it's just your own household gross income, okay? Not after tax, before tax, and that's a good thing, because before tax in this country, you would hear my salary is 100,000. After tax, and you collect your salary, you see that your salary in reality is like 50 or 60,000. So the good thing is that the bank is counting the gross, not after tax, not the net, okay? Okay, that makes sense. All right, so if I'm a single person and I want to qualify for a house of 800,000, the bank is going to calculate my income and times it and multiply it by 4.5 or 5. So if my income is 200,000 per annum gross, they are going to do that times 4 or times 5 or times 4.5. So for this example, I'm going to use times 5. Times 5 of 200,000 income will be $1 million. That means I'm going to qualify for a $1 million mortgage, okay? It's important that I mention that the fact that you qualify for a $1 million mortgage does not mean you have to use all the money you are qualified for. So if my dream is to buy a townhouse of 400,000, It does not matter if I am qualified for 800 or $1 million. I can simply just go look for the house that I want to buy and tell the bank that this is the amount of the house that I found, and it's 800,000. What they will do is that they will just finance for 400 for you, not the 1 million that you qualify for. And before I go into my other points, I just want to also say that if you qualify for 1 million based on your yearly income, whether as a single person or as husband and wife, your family income combined, they are going to remove every credit that you have before they give you that final approval. What do I mean? So let's say, again, I qualify for $1 million house, but I have a 10,000 credit card. My husband has a 10,000 credit card. That's 20,000. They're going to remove that 20,000 from the $1 million that I qualify for. So I think I should use a smaller amount so that you understand the impact of what those credit can do. So let's say my mortgage is 500,000 that I qualified for, and I have a $10,000 credit card. My spouse has a $10,000 credit card. They are going to remove 20,000 from that 500,000. Now my mortgage shrinks to 480,000. Okay, say I bought my car and I'm financing my car, and my car is $10,000. They're going to remove that $10,000 because what they are simply doing is something they refer to as a stress test, okay? Which, when they finish minusing all the line of credits that you have, they are also going to put a certain percentage of, so let's say your mortgage, you got it at 5% interest rate. The bank would add maybe 1% again or 2% to see if interest rate goes up, will you still be able to pay your mortgage? These people are very smart. Banks don't lose money. So, when the stress test is done, they will be able to know that, okay, even if this interest rate is to go up, this person will still not default. There will be no need for foreclosure. This person will be able to maintain their house. That's why they do what they do. So, if you're new in Canada or you are planning to buy a home, you definitely want to be careful in the line of credit that you are taking along the way. It's very, very important. Now, once you finish with the whole banking thing, you have two other options. One, you can go and look for a house that you like yourself. Another option is to look for a realtor, someone that would help you find a house. Good thing in Canada is that these realtors don't even charge you money, because if you buy a house through them, the percentage that they get is crazy. So, but it's up to you if you want to use a realtor or you just want to go and look for the house yourself. In my case, I did both. I had a realtor and I was also searching. And luckily for me, the one we found was a house that a friend of ours had seen and said, you guys should come and check this out. So we didn't have to go with the ones that the realtor had found for us. So now you found a house, Osa, you go back to the bank, because the letter the bank is going to give you at the beginning when you apply for a mortgage is going to be something they call a pre-approval letter. It's not a final approval. You can get a final approval if you found the house already before you approach the bank. So the bank will just come. Sometimes they send, if it's an old house, they will send someone to go and look at it and make sure that the house is worth the amount that you are telling the bank to finance that house for. Usually, if it's a new house, they don't bother because they know they will just use the current. They have a way of knowing if the house is worth it or not. Let me not talk about the bank and what they do. So, anyways, now you found a house, you have your pre-approval before you go back to the bank to get your final approval. So now that you have your final approval, from that moment on, you have to get a lawyer. Now, your lawyer is the one who is going to be talking with the bank from the moment you've secured that final approval, okay? The down payment that you have also, you also have to give that to the lawyers. So you send your down payment to your lawyer, you pay the lawyer fee, and it's important I also mention here that there are other fees you pay aside the down payments. Very important, thank God I remember. If you're buying a house in Ontario, for example, there's something they call land transfer fee, which you have to pay. If you're buying a house in Alberta, which in our case is Calgary, you don't have to pay a land transfer fee, okay? Now, there is a mortgage insurance fee. You have your lawyer fee. If you are going to use an inspector to check the house, you have to pay. There are some other tiny fees like landlord association fee, like in this place where I am, I have to be paying a certain fee every year to be able to use the facilities and everything else, like the parks and all of those things. So the mortgage is not the only thing. Your mortgage insurance is something that comes really, really high as well, because should something happen, you want to be able to have a good insurance that covers the house. I don't know if that makes sense. And you can't even buy a house without insurance in Canada. Anyway, you can't even buy a car without insurance in Canada. So these other tiny, it's not tiny, but these other fees are things that you need to ensure that you considered before jumping into buying your dream home. I have to say that someone gave us a very valuable advice when we're looking to buy a house, and let me just share it with you guys. If you are a husband and wife, or you are a single person that wants to buy a house, just make sure that the home you are buying, if one person is to lose their job, one person's income will still be able to pay that monthly mortgage. It sounded like, but I understand now, because I'm on maternity leave now. I finally took my maternity leave. But just imagine if I'm on maternity leave and we got a house with the mindset that my income and my spouse's income combined is what we're going to be using to pay for that mortgage. It will be very tight right now, and that's how people fall into the trap of foreclosure. So you want to just ensure, okay, 30%, 40%, 50% of my income should be able to pay for my mortgage. I don't know how much you earn, but just make sure that, just have it at the back of your mind that if one person loses, God, it's not, as a Nigerian, we always say, God forbid, if one person is to lose their job, because this is real life, Google is throwing off staffs. Recently, we saw all over the news, Facebook, everybody downsizing. Okay, it can happen anytime. So that God forbid thing is true, but hey, God forbid, yes, but wisdom, knowledge says buy if one person income at least can pay for the mortgage. I learned something from Dave Ramsey, who is a well-known property guru, that real estate, that millionaire guy or billionaire guy. Okay, you probably know him too. He talked about someone or some people being house poor. That thing is is very real. You can live in a big house and be house poor. What house poor means is that your entire income is being sucked up by your mortgage or maintaining living in a big house. That is not necessarily a good thing. I remember when I remember when I was in Nigeria, I used to see some people then growing up in Abuja before I moved to Lagos. You see someone living in a very big house, and when they come out, you are living in a flat, you look better than the person that is living in a very big house, you know? Because some people will just buy a house of $1 million, like what's going on in Ontario right now, buying a house of $1.2 million, $2 million, and you're taking 3-4 jobs just to be able to pay for that mortgage. Guys, like, I want to be able to buy a home and look relaxed and breathe, and when I'm there, I'm like, thank you, Lord, for this home. You know, I just want to be able to enter a house and breathe and enjoy the fact that God has blessed me with a home. Not to be looking for a third job, fourth job, fifth job. Like, there's nothing wrong if you want to get as many jobs, you have the strength, but let it not be because you are struggling to pay for a mortgage, okay? Always buy something that you'll be able to pay for within a comfortable income bracket, okay? So it's very important. That advice was given to me. That advice was given to me for free, and I'm giving it to you for free. Okay, it's very important. A lot of people buy a home, and you will not believe how many people actually foreclose that same home in a very short period. You're buying a home because you want to build equity, okay? You're not buying a home so that after a while you lose the entire thing. So, talking about equity, if you finish buying your first house and you want to buy a second house, that's where your equity, that's where your equity comes in. So equity just means in the next 5 years, if government values this house or the value of this house increases, whatever it is minus the amount I bought it for, I can use my equity that is now on this house to even purchase another house or add some money to what I have as equity to buy another home. Real estate is something that, I wish I had this knowledge that I have now, because you just can't go wrong. A lot of people who are smart investors, they don't sleep on it. There are people who buy, sell. There are people who because houses will always appreciate, right? It's an asset, okay? It can become a liability, but in 99.9%, it is an asset. So I wish that I had the knowledge that I have now, but now that I have this knowledge, I'm happy to share with you. And by God's grace, I'm going to keep investing if I have the opportunity to. And I'm telling you guys, you will not regret it. I hope I covered all the things that I had in mind to cover in this video. But if I did not, please leave me a comment. And if you check my videos, you'll see that I always respond to comments. Thank you so much. Let me know if you're planning to buy a home, where you're planning to buy a home, okay? What I almost forgot. This person asked me this question this morning in the comment section. How much is the cost of a house or houses in Calgary right now? First of all, I'm going to talk about the type of houses that you'll find here in Canada. Starting from the biggest one is a single family home front garage, or single family home with attached garage, let me call it that way, because now they are attaching garages at the back too, and they are different from lane homes, okay? So you have single family homes with attached garage. After that, you have lane homes. Lane home is what I have, where my garage is not attached to the house. Your garage is at the backyard, and then you have your own backyard space. That's a lane home. It's also a single family home, but they are lane homes. After that, you have something they call townhouse. They call duplex. So in Nigeria, right, the things that I thought was duplex here is not what they call duplex, and it makes sense. Duplex just means two. So you have two houses joined together as duplex, okay? And two people are sharing. Two owners so you can buy a part, another person can buy a part of that house. Now, after that, you have something they call townhouses. Townhouses are maybe 3, 4, 5, 6, 7 houses in a row. I'll try to look for a picture of this to explain them better. After townhouses, you have apartments, condos. Condo is what we call flats in my country. Blocks of flats, or popularly known as condo in this part of the world. 3-bedroom flats, 4-bedroom flats, 2-bedroom flats, 1-bedroom flats, studio apartments, which we call self-contained in my country, studio apartments. Now, these are the type of houses that you can buy. And you can just, some people just prefer to buy condos, which have different flats. Reason for that is maybe they just love to be in a place that, you know, has a lot of people. And then, so I'm just going to talk about the prices, and I'll try to also look for something that is close to the current market rate to put on the screen for you guys. So a single family attached garage home right now in Canada, depending on the square, again, it's important, all houses are not the same. It can be standing alone, but the square feet might be big. The things that they've put in that house, they've upgraded everything, so the prices can, what I'm just giving you is average, okay? It's not exact. For an attached garage home, guys, if you have anything between 1 million to 850,000 ish, you should be able to buy an attached garage home. If you are looking to buy a lane home, we are talking anything from 700 up until at least right now to 600,000. You should be able to buy a lane home for that amount, from 800 to 600,000. Bear in mind that most of the house that you will find within that 600, 620, 650 lane home, likely they did not finish the basement of that house. Now we move from that to duplex. Duplex right now, you can find a duplex from 550, 500 up until the 580s for a duplex right now. For a townhouse, it's already in the high 400s. And for condos, depending on location, depending on the amenities in that condo, if they've put gym, they have swimming pool, they've added some recreational, you know, it just depends, okay? You can be getting a condo for a 2-bedroom condo or a 3-bedroom condo for the high 300s, again depending on the location. So I'm just grateful that I remembered all of that right now. So let me know in the comment section down below, and if you have any question whatsoever, put it down and I'm happy to answer you guys. Thank you so much. Let's not make this too long. Bye.